Welcome to a new era of insurance, where innovation meets necessity. Today, we'll explore the trends and patterns shaping the Insurtech market. Let's uncover key insights and look ahead to what the future holds for this rapidly evolving industry. Insurtech investments have focused on emerging technologies rather than holistic industry value. With a steady growth rate of 8.26% since 2018, the market saw major waves in 2021. Despite stable funding in the last 2 years, optimism is building for another surge, fueled by scalable innovations. Investor confidence has slowed, evident in a 2-year gap between IPOs. Recent IPOs like Digit Insurance and Rosin in 2024 hint at cautious optimism. Meanwhile, leading candidates like WeFox and Next Insurance plan for 2025, signaling a market shift towards scalable, long-term strategies. However, regional funding trends reveal critical differences. Global funding has cooled, but regional differences stand out. In the U.S., a decline from 516 to 157 investments reflects a focus on profitability and market maturity. Europe emphasizes pricing technologies amid regulatory challenges, while APAC prioritizes scalable distribution platforms, marking the steepest drop from 196 to 46 deals. Among these regions, Europe's rise stands out, achieving a record-high deal share of 35% in 2024, driven by macroeconomic stability and reduced market volatility. Historically seen as a challenging region due to regulatory complexities, Europe is now attracting significant investment as a lower-risk alternative to the U.S. or APAC. This shift is underpinned by Europe's emphasis on pricing precision and innovation, positioning it as a hub for sustainable Insurtech growth. But what's fueling this momentum? If we examine the funding dynamics at different stages, we observe that Series A funding has seen a significant jump, reflecting increased interest in early-stage startups. Areas like telehealth, IoT-driven home insurance, and core modernization align with market demands for cost-effective scalability, signaling investor confidence in bold, new business models. Another interesting trend is the rise of alternative funding strategies. Debt financing has grown at a remarkable 97% CAGR since 2021, showcasing startups' adaptability. This trend highlights startups prioritizing operational scaling despite higher financing costs. With careful cash flow management, Insurtechs demonstrate resilience and flexibility, ensuring sustained growth in uncertain economic conditions. From the tech side, AI and machine learning dominate, accounting for 1B of 2024's 4B investments. With proven capabilities in automation, cost reduction, and personalized experiences, AI is the cornerstone of insurance transformation, driving innovation across the value chain. AI's transformative power extends to health and P&C insurance. Solutions like Gradient AI streamline claims, while Quantev enhances underwriting in life and health. These technologies reduce costs, improve workflows, and deliver better outcomes for insurers and customers alike. This brings us to identify the fastest-growing Insurtechs and how they succeed by adopting innovative strategies. Pricing intelligence platforms like Accur8 and HyperExponential achieve 1B valuations by aiding companies like Lloyd's or Tokyo Marine. Full-stack models improve customer experiences in health and auto insurance, while tech enablers drive new revenue streams through new distribution channels or new granular data insights. These strategies exemplify the Insurtech playbook for market success. But Insurtechs don't succeed alone, and their collaboration with insurers is vital. Following the fastest-growing Insurtechs, we've seen key strategies from Insurtechs to empower insurers by building platforms that enhance underwriting, pricing, and distribution. And by addressing protection gaps and integrating into insurers' core operations, insurers create new capacities that meet evolving customer demands, increasing the possibility to scale these Insurtech models in the market. Let's dive into public Insurtechs and their market evolution, highlighting their strategies, challenges, and milestones in profitability. Around 2012, companies like Lemonade, Oscar, and Hippo impacted the market by going digital and making insurance more accessible and sexy. Despite their early success, they faced important challenges slowing their growth and affecting performance results. This, and the current market environment, forced them to do a strategic shift towards profitability reflected in 2024, with clear superior performance conclusion in a 200% growth in share prices. There are various reasons for such a drastic improvement in stock performance, but probably the most important is an improved P&L. The deflated losses and improved ratios are turning to be the bedrock of improvement for these companies. Lemonade again emerges one of the most notable examples with an outstanding growth of 160% in the last year, continuing with its path to profitability, fostering a more efficient and robust business. Improved P&L and operational metrics highlight their ability to adapt and sustain growth. Last year, we talked about Lemonade's strategic shift. By diversifying products and leveraging AI insights, they elevated premiums while maintaining cost control, showcasing the potential of focused execution. This strategy resulted in 2024 in a notable increase of their in-force premium from $609 in Q3 2022 to an $889 in Q3 2024, and a constant operational expenses, excluding customer acquisition costs, at $85 in the same period. The second aspect, based on their European expansion and AI-driven fraud detection, achieved a healthy 73% gross loss ratio in 2024. This combination of market growth and operational efficiency underscores their scalability and resilience. Lemonade embodies the Theseus paradox that says, if all planks of the ship are replaced, does it mean that we still have the same ship? So, does Lemonade's evolution make it an insurer or a new-age tech company? Retaining an innovation-first ethos, with 70% of customers under 35, it mirrors tech disruptors like Spotify, proving the power of digital-first models. Compared to fintech and health tech, Insurtech valuations lag behind. However, growing adoption and stable adjacent industries indicate strong potential for future growth. With investor confidence rising, Insurtechs are poised to close this gap. Thank you for your time. The future of insurance demands bold innovation, collaboration, and leadership. Let's shape this transformation together. Reach out if you'd like to explore further opportunities.